Let's cut back straight across. Conversation with Blue Star. So despite GST cuts, room AC sales in the festive season were weak, right? Any outlook on the recovery in the industry? And give us a sense by next summer as well. Is H2 shaping up better than H1? And then thereafter, are we expected to see stronger traction?
H2, as of now, we will say that the demand is yet to pick up. There was a good initial surge at the time of festive season, but after that, we have seen again it has tapered down a little. The whole of the thing will depend on how the sales really play out in the last two weeks of December and say in month of February and March. So that's going to be a more determinant factor when it comes to H2. Having said that, post GST announcement, we had hopes that it's going to pick up faster. It's little too early to say on how it is impacting. We have not seen the kind of surge that would have been expected post GST announcement. But definitely, when the BE norms changes, the pricing change, which would have taken the price further up, at least that is going to be arrested now because of the GST, and which should help for the demand going forward.
Right. Also, we've seen slower order inflows in the electromechanical project segment, right? How does this impact the broader FY26 execution outlook?
As far as electromechanical projects go, I think this quarter we had seen kind of the order book having a degrowth. Otherwise, it has been a long kind of period during which the industry growth has been there as far as order book goes, and we again feel that it is more a timing impact with few of the projects getting completed or finalized post the quarter. Hence, we should expect a 10 to 12% growth over there. That's not something which is a major area for concern. Having said that, we are also looking at which projects we would want to focus on, and that is something which will drive the execution going forward. Focus will be more on factories and all, and that's something which we will be looking at for execution. As far as the execution cycle goes, when it comes to infra projects, it's around say 3 years to 4 years, whereas a factory or data center can be a year and a half. So you can do much more projects if you have to go for a factory kind of mix, and that's what will drive the execution.
And unitary cooling products, UCP, margins guided at around 7.5%. What levers will the company rely on to sustain profitability amid softer volumes and deferred demand?
Yeah, so the UCP margins, as I said, 7 to 7.5% is the guidance is for this year. On a long-term basis, if you have to ask, the guidance continues to be around 8.5%, and that's what we will be sticking to. This 7.5% is because of the current year, where the certain amount of fixed costs do continue, where there is a softness as far as the volumes go. So this is not a long-term guidance. This is just for the year guidance. There will be a focus on cost management. We will try to see how kind of we can maintain the variable cost at a very low level. Wherever fixed costs can be eliminated, we look at that also. There are certain levers like advertisement, sales promotion, all of which kind of are the levers which we can manage the cost as and when we see the softness in demand, and that's what we will continue doing. We are quite confident that this is a very temporary phase, and next year when you see the demand come back, I think the margins should roll back to 8.5%.
Right. There's also been a shift from a net cash to a net borrowing position, right? How is it that we should interpret this in terms of working capital needs versus strategic investments?
Yeah, so the strategic investments, as far as the company goes, we have always said that the capex is going to be, capex including R&D spends are going to be in the region of around 250 to 300 crores, and that will continue. The cash position which was there should also be connected with the QIP issues which was done around 2 years back, so which has kind of over the period helped us build on the cash position. The current year, while of course the QIP funds have been fully deployed last year, this year there was also an increase in the inventory levels because of the weather impact which was there, and that has led to the increase in working capital. So this again is a build-up. The borrowing which you are seeing is a build-up because of working capital which have been kind of higher on this year. as we see the Q3 and Q4 approach, we expect that by the end of second half, we should be reasonably down back to either very low level of borrowings or maybe some amount of cash position.
And give us a sense on how the commercial air conditioning business is shaping up amid increased demand from data centers and manufacturing.
So as far as commercial air conditioning goes, we are expecting H2 to be better than H1. We can go for the guidance of around a 12% growth there. The demand is coming from data centers, factories, as well as, of course, the various infrastructure investments that are happening across tier 2, 3, 4, 5 towns. When it comes to data center, we are more in the MEP space. Of course, we have launched a data center chiller, but it is still at a very early stage. And the data center demand for the product, more than the product, we are in the MEP segment that we are participating.
Okay, thank you so much, sir, for coming in and speaking with us, giving us that outlook and context on what to look out for going forward. Big part of consumer discretionary, of course, will be this play with regard to ACs, and Blue Star, of course, at the forefront of that, giving us that outlook. What we'll do is we'll slip